Hi there, a very warm welcome to Simply Stocks. And today I'm going to talk about Mirza International, which is at 52. And in my opinion, it is an avoid, and I'll explain why I believe that it is an avoid. So let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position into any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Now about the company, Mirza International is a brand into shoe manufacturing and footwear established in 1979. So it has been around for the last 40 odd years. It manufactures leather footwear and finished leather. Red Tape is its major brand, and has Red Tape has done well over the last 5 to 10 years. Uh, Apart from that, there are no major brands that we talk about, and there is stiff competition with other companies. So we'll get to that competition part later on. There's a decent dividend payout that the company has done over the last couple of years, but then you need to understand that companies give out dividends. Or good dividends only when they are very profitable, and the business keeps on doing well. What is essential for a company to do is probably to have more market share going forward and become more bigger in the industry, which I feel Mirza International is struggling to do compared to other companies in the sector. It is a leading global supplier over the last 15 years, so it is more into exports, whereas competitors and larger company Bata or other companies in this segment like Liberty, etc., they are more into India. They are more into the mass, you can say, selling of products to the school going children, to all age group people in India, whereas Mirza International is more focused on selling its products globally. Leading global supplier over the last 15 years, as I mentioned, supplying to 30 countries globally. So around 30 countries it supplies to, and it's include United Kingdom, it includes USA, France, and Germany. The market cap of the company is around 700 crores, so it is a small cap that we are looking at, and not a mid or a large cap company. Another thing I need to point out here is that while Bata and Relaxo, for instance, has done extremely well over the last year or so with respect to stock performance, Mirza International has lagged behind, and probably the reason are, as I mentioned before, with respect to competition, market share, etc. If you look at the financials, and these are September or Q2 21 numbers versus last year, and this is more like open as to how things have went on. So sales have dropped by around more than 11%, and at 272 crores. We had profit which has dropped by around 30% at 6.4 crores. There is high promoter holding. That is pretty good, that the promoter holding is pretty good. But just to come back to sales, so if we just extrapolate the sales from a 4 quarter basis, then the sales would come out to be around somewhere around 1200 crores, or just under that, around 1100 crores, whereas the market cap is around 7 800 crores. So in that regard, the company looks attractive. That market cap to sales, this is something that I look at in most of the companies. The stock look extremely attractive, but when you look at the profit degrowth that has taken place, and you need to understand that most of the companies or major companies in the large and mid cap sector has done exceedingly well once the pandemic has ended, once or not ended but has subsided a bit, and from the second half of 2021 they have been doing well. So why would somebody get into something like a Mirza International, where in other sectors like auto ancillaries, autos, you look at consumer electronics, and in other businesses, most of the companies are coming out with 25, 30, 40% profit growth, pipe manufacturing, etc. So even in real estate ancillary, the companies are producing very good numbers. But to go ahead, the positives are that the company has high promoter holding. Uh, the debt is extremely high, and that is why probably we have a you can say a curtailment in terms of profits, and probably they need to just take care of debt and reduce their debt. Being a consumer company, I have always liked companies which are more or less debt free or with less debt, or they are producing very very strong numbers or are market leaders having some debt. Now this company is not quite a market leader in the shoe and you can say footwear segment. It is a small cap, has not done that well over the last couple of years, plus it has debt on the books which it needs to reduce, because right now the interest rate regime is extremely attractive for companies who are even having debt. But once interest rates turn around, maybe in 2 years, 3 years, 1 year, we don't know, these stocks will be taken to cleaners, and that is my concern with these companies, and that is another reason why I believe that the stock should be avoided. Return on equity at 8%, 8.3%, operating profit margin of 15% is fine, but not out of realms, not something that really blow your mind off and you can say run for buying companies. Even in the small cap segment, even in this you can say band of around 300 to 1000 crore market cap companies or like that, there are companies which are producing 25 to 50% CAGR profit growth in that region with very good return on equity and very good net profit margin. I'm not talking of even OPM, but even net profit margins are top class. So hence that these are the reasons. So if you go through the whole presentation, you'll understand the reasons that I'm putting forward as to why the stock is at 52 and not at 152 odd, because these are major concerns. These are not small concerns that an investor would be having, and that's why large investors would stay away from such companies. So if you look at the performance of the stock has relentlessly fallen since July of 2017, and probably the reasons are all out there as I mentioned. And the stock fell from around 165, 170 as I remember. So it's down around 65% from those highs, and that's where retail investors, innocent retail investors, get lured into that our stock was 165, now at 50, so let's buy. It may again go to 165, new highs, everything is making new highs, so this one will also make a new high. And I was of the same opinion about a decade back, say in 2012 or so, 8 years back. I was buying into stocks in the same manner, and looking at probably its 52-week high or 2 year high and thinking that it will happen. So it doesn't happen like that. You need to understand the fundamentals of the company, and right now the stock is down because of the reasons as I have just mentioned. Return ratios have been subdued, and this is the biggest reason why the stock is down, because they need to get the debt down so that the return ratios get better especially on the bottom line. Fell 50% in the February and March fall, and you need to understand it has recovered from the fall of March, but it has not like gone to new highs as other companies have done and recovered very sharply. Like we had V-shaped recovery again, as I mentioned, in tractors, auto ancillaries, consumer durables, even consumer, you can say FMCG, in real estate, infrastructure. You look at all across the board, things are looking very good in banking, etc. So why would somebody get into such a company? Also, even the largest company in this segment has done exceptionally well. So you look at a Bata going from 1000, 1100 all the way to 15, 1600, has recovered very sharply, although it is one of the larger or the largest company being listed in the market at the moment. So as I mentioned, even though it is a small company, the ratios are not coming through and the numbers are not that great. For a smaller company to grow bigger and quickly at a larger pace with larger, you can say, profit CAGR is much easier, and even in that case the company has not done that well compared to their its larger counterparts. So it recovered to an extent, but really not set the house on fire. Numbers not improving compared to larger peers, as I mentioned. If you look at the technicals, then the 200 DMA is around 48, very close by 47, 48, round about there. If you really want to trade, probably buy around 48. There is strong support at 44 to 46. So any sort of declines during budget or after that, probably if you really want to buy this company, buy around 49, 49, keep a stop loss at 45. A breakout is expected only above 70. Looks very weak technically and very weak on charts. uh, Wait for confirmation on the charts to buy, even if the numbers, so suppose the numbers are going to come up after 2 quarters, the stock may continue to move. So confirmation would come up above when it crosses 58 to 60 levels at least. So low deliverables is a concern, so people trade into it intraday and don't take deliveries, etc. So these are all concerns with respect to Mirza International at the moment. So what needs to be done? In my opinion, it is a avoid for the time being. Look for leaders in this space to buy. So even a Bata is a much better option on declines to even trade in. I've always been a favorite or favoring those companies you need to trade in which you are very comfortable buying into. So you trade those companies also. Don't trade into, you can say, lower quality companies with respect to numbers. Nothing against the management, but with respect to numbers, whereas you invest into the best of the class of the companies. So keep track of numbers. If numbers do improve, if things really change, yes, of course you buy and have less than 5% exposure into such stocks. So this was my video on Mirza International. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.